In this video, we're going to be looking at cash flow statements, and some of the objectives discussed include defining what a cash flow statement really is and what cash flow actually means. We'll also look at some of the elements that are important and are used within cash flow statements. We'll understand some of the data used within, and hopefully we'll put that into perspective on an example of cash flow analysis with a popular company that's listed in the London Stock Exchange at the moment. And before finishing, we'll have a look at free cash flow and then finish with limitations of cash flow statements and how they may not be so useful in some respects when analyzing a company. So, what are cash flow statements? Well, they show the amount of cash and cash equivalents that flow through a company, so money that comes in and out. And using these statements, investors can figure out whether a business is liquid or not. This particular term, liquidity, let's just say a business is getting a lot of money in and they're not paying that much money out within, say, a period of, a year, for example. That business is liquid. What if a business is paying out a lot of money and not getting that much in to fund the business's operations? Well, that business is likely to be illiquid. Now, cash flow statements are also required in financial reporting by businesses in the UK under regulation. We're going to now have a look at some of the key elements involved in a cash flow statement. And we're going to begin by dividing each subject area into inflows and outflows. So with borrowing related flows, for example, we're going to split it into additional borrowings versus debt repayments. Now, with respect to additional borrowings, those account for the use of a credit facility or taking a bank loan. If you want to borrow some money and say you use a bank loan, then that money is coming in to your business accounts, and that is therefore classed as an inflow. Now, if you were to pay that money back through debt repayments, which are shown here, let's highlight that, that's the debt repayment, then it would be an outflow. So let's go on to the next one, operational flows. And the first one, being the inflow, would be an increase in trade. That means you're selling more as a business, then you're getting more revenues, meaning more money is coming in, and that is classed as an inflow. With changes in inventory, that could be classed as buying more stock. For example, you sell a physical product as your business. With the example we're going to use later, they sell tobacco and say you buy more of the materials used to develop more of your product, then that will be an increase in outflows on your cash flow statement. Now, with respect to dividend flows, an inflow would be classed as dividends paid in from investments that you have made as a business. So if, American Airlines, for example, bought part of another small airline, and that business made money, paid dividends, or gave them capital appreciation, then that income would be classed as an inflow. And if, as a business, they paid a dividend to all their shareholders, say American Airlines decided to pay a dividend of, something with a 10% yield, then the investors would receive that capital, and that money is classed as an outflow. That money goes out of the business and therefore classes itself as an outflow on the cash flow statement. So with FX flows, we've got two separate areas as well. You've got gains in currency. So let's say you're a business that sells your product in dollars and you do your accounting in pounds. You're listed on an exchange in the UK. You're reliant on the appreciation in the pound against the dollar to give you more gains in your currency, which classes as an inflow on the cash flow statement. And you can also have losses, though, on the other side as a result of market volatility. And that happens when your host currency, the one of which you are accounting on, depreciates in value versus the one that you got revenues on. So with the same example we use, let's just say the company is making dollars, US dollars in their revenue, but they're doing their accounting in the UK and their shareholders are mostly based in the UK and rely on that. Then the important thing to consider here is that if the pound weakens against the dollar, they would get losses as a result of market volatility. So now we're going to look at how we can interpret cash flow data. Using some of the flows mentioned in the previous slide, including borrowings, operations, dividends, and foreign exchange. You can use some of these to help yourself interpret the data. These are the bits of data involved, and you would look for unexpected changes, any unexpected changes from looking at previous year's worth of financial data. So we've given one example here. When you have a large increase in inventory levels for a business, it would be interesting to ask yourself why that happened. Some businesses like to increase their stock ahead of a period of expected hikes in demand. So supermarkets, for example, maybe they're going to increase their stock ahead of, for example, we've had recently the COVID-19 period where people were looking to stockpile toilet paper. They were looking to stockpile things like milk, basic necessities, bread, and other things like that. But this is probably more of a generic example. A lot of the times you have businesses see oil prices be higher, so maybe they would hike their production. They would look to frack certain wells and maybe try and get as much revenue as they can within a period, but to do that you have to spend money up front. So really, by looking at these bits of data, you can ask yourself why the changes occurred, but instead of just asking yourself why it's occurred, you can come to a conclusion by conducting further analysis. And we put it on the screen here. You'd ask yourself why that change has occurred. If you don't get why it's happened, look deeper, conduct further analysis, or due diligence as the term is used in the industry. And then once you come to your conclusion, you act accordingly, in line with the outcome of your investment case. So if you think that a company is 25% undervalued, then you would likely look to take a long position. So if for some reason you think that the company is extremely overvalued, you would go short accordingly with your investment case. So now we're going to have a look at Imperial Brands' 2019 full year cash flow statement, and we've divided it into two parts. This is just a brief example. We're not going to spend too much time on it, but you can see things that we can highlight here. Operating profit, so that's the money that the business is making that's coming inside to their accounts. You can see 2,197, and that's priced in millions, so that's just under 2.2 billion pounds, and that's down from their 2018 performance. And if you look at some other terms, you probably wouldn't have heard of depreciation, amortization, and impairments, but we will have a separate video on that. If you look at inventories, you can see the differences between previous years. Trade and receivables, money owed to the business. Changes in here are shown here. The increase in trade and other payables, money that is owed to other businesses, will also be shown in this statement, and the relevant tax. If we look at two clear sections, we've got operating cash flows before movement in working capital there, and then you have movement in working capital in a separate section alongside tax. You will get the net cash generated from the business being in place. So really, this bottom figure is the quote-unquote bottom line for your data and your analysis. So you can see 3,087 million, so just under 3.1 billion in the net cash from operating activities figure has now risen despite the operating profit being lower. So in terms of liquidity, the business is more liquid. However, is the business making more profit than before? At this moment, it doesn't seem to be doing so. We'll now have a look at the second part of this cash flow statement, and we must remember on the right column you have data from the previous year. In this case, we're looking at the 2019 cash flow statement for Imperial Brands. This is the example we've been using, by the way. It's a company that sells tobacco. You may have probably heard of them. If you haven't, well, that's all you really need to know at the current moment. And on the left column, as we were saying, the data shown represents data from the current year. So if we dive into this a little bit, we can see that the first area shows cash flows from investing activities. You've got money coming in from loans to joint ventures, all sorts of things. Purchase of non-current assets, that's an important thing to know because that was quite a significant makeup of this cash flow statement. Non-current assets are assets that last for longer than a year. So property is an example of a non-current asset. It's not only the purchase of non-current assets that can occur. You can also buy businesses and brands and operations. We've shown by the example here of Imperial Brands that in 2019 they spent nothing £0 on the purchase of businesses, but in the previous year, 2018, they had spent £8 million. And it's important to show the main parts of a cash flow statement. These two areas we've shown on this image. You've got cash flows from investing activities and cash flows from financing activities. Remember, investing activities are ones that are aimed to create value. By partaking in an investment activity, you try to get a return for the business. So it's possible that Imperial Brands had spent more on non-current assets to maybe make more money in the long run, or at least increase their revenues as much as possible, catering for a potential hike in demand. Who knows? But with regards to these investing activities, if you can't finance them, then you're going to be unable to partake in them. So you have flows from financing activities here. You've got interest that's shown roughly constant. You can see 488 million in the current year versus 501 million in the previous year. So 488 million was spent just on interest alone, servicing the debt that the business had owned before. And that was a little bit down from the previous year's 501 million. You can also look at the increase in borrowings. They borrowed a lot more this year versus the last year, and that means their liquidity was much higher in the short term, but you got to worry about them borrowing 2 billion roughly on top of what they did in the previous period. They borrowed 1.6 odd billion in 2018 alone, just from an increase in borrowings, and now in 2019 they borrowed almost 3.7 billion pounds just within that period. So it may look good for their cash flow statement, but it doesn't mean that the company is necessarily doing better. Look at their repayment of borrowings figure. If we align this here, 2.33 billion was paid in 2019 just towards their existing debts, and that's not interest, that's repayment of the borrowings. And if we look at the previous year, 2.261 billion. So that's roughly constant. So things at the current moment are manageable, we can only assume. But in the long run, taking on this much additional debt, the exponential growth of their debt accumulation is a little bit worrying to someone who would be analyzing this cash flow statement. But if this is made up of a majority of short-term debt and is being financed by an inflow from a contract or something, or a huge sale of their tobacco products, then it would be understandable and it wouldn't be a red flag. But under this circumstance, you would like to read further into that. So by using the data in the previous part, the first part of Imperial Brands' 2019 full year cash flow statement, we can see the net cash generated from operating activities. Remember this figure, and this is used in line with the second part to calculate that net increase in cash and cash equivalents, 1.54 billion pounds. And they had cash and cash equivalents at the start of the year of roughly 775 million pounds. So by adding these two together, taking away changes in foreign exchange rates and a couple of other things, not too serious bits to worry about here, you get their cash and cash equivalents at the end of the year. And you compare that to the previous year. So at the moment, they are much more liquid than they were previously. But what this doesn't tell us is the truth about when they are going to pay back their debt. So maybe they would have 3 billion in debt maturing at the end of the next year, which isn't able for us to be seen at this current moment. So we're going to look at some of the limitations, but before we do look at the limitations, I think it's important we look at the term free cash flow and explain a little bit about what it is. A lot of people think free cash flow is profit, not specifically. Free cash flow accounts for the operating cash flows, otherwise the flows made from the business's operations, as the word operating says, and that you will take away the capital expenditures from, which are expenses in those operations. So to calculate free cash flow, you get operating cash flows and you minus the capital expenditures from that. And then you have your free cash flow figure. But whilst it's important to use data like free cash flow to understand more about a company's ability to manage its flows in and out of the business, there are some limitations of cash flow statements in general as well. It's important to remember that you have time lags. So if a business is making $500 million in free cash flow, and then for some reason in the next year they're suffering in terms of their financial performance. It could be a possible situation of a one-off where money had been coming in at one point of the year. So let's just say in 2019, these guys had a lot of debt that was maturing, and in 2018, they had a lot of revenues, a lot of profits, and their cash position was quite strong as well. Well, you wouldn't specifically invest in that business just on the basis that their situation was good the year before, because now, all of a sudden, the profitability figure had diminished and they lost more than they'd made in the previous year, which means the previous year basically didn't exist. And even if you had the most recent data available for a company's cash flow statement, it's not a great indicator of future growth. Past performance does not necessarily look to a future return. And I could give an example just before finishing. Let's say a business has a lot of debt, in fact, billions of debt, let's just say, and that debt matures 10 years down the line, but the current model is making 20 or 30 million a year. Let's say the debt figure that was maturing in 10 years was 5 billion, which is a crazy figure. And then you have the business only making 20 million a year. Your worry is that it might be difficult for them to service that debt because in, say, 10 years' time, roughly 20 million a year net, let's just say, they're making 200 million a year in that case, and 200 million of cash would have grown. But their debt that matures and the additional borrowings taken on to service that huge debt, 5 billion is probably a large figure, but hopefully you'll get what I'm trying to bring across. You have to look at things in perspective. So hopefully from some of the videos in this Essentials series, we'll be able to help put things into perspective and use multiple different tools of analysis at your disposal. Cash flow statements where you can analyze all sorts of things, income statements, balance sheets, and so on.